It's a pretty lovely good evening once again from here in Delhi, and hope as always that each one of you are keeping well, happy, and of course in joyful mood and high spirits. So today we are starting the journey of CFR with this highly formidable, important, significant, crucial, and highly critical chapter, business combination. I have already told you this is very important in the sense if we are going to actually analyze the pattern of the last 3-4 attempts, we would find actually that almost every year question is striking from this particular chapter with great force and great velocity. So all this should actually motivate you why you need to actually pay a very high amount of attention and very insightful amount of attention. Correct? So it is of paramount importance for us to actually comprehend the conceptualities of this particular chapter in a very formidable manner so as to earn a very sophisticated command so that we are well prepared to tackle any sort of what we call questions which may be tossed up from this particular chapter. So before we start explaining what exactly Ind As 103 is and what exactly the guidelines of this particular Ind As with respect to business combination, but first we need to have a look over some significant concept, and as a professional student you need to be aware of all these significant concepts because that will hold you in a very good state and also will help you a lot in comprehending the conceptualities and intricacies of this particular chapter. So if you are ready, then we too on our side are absolutely ready, and I would love you to actually pull out your pen, pencil, register, etc. and presume as if you are sitting in a regular class. Correct? This is of paramount importance actually when you are attending these sessions. So as I told you, before we start explaining the concept of Ind As 103 and what exactly the business combinations are and what exactly we are supposed to do, first of all, we need to have a bit of idea regarding some significant concepts and what exactly I mean by some significant basic concepts. Let's have a look over here. So, kindly actually pull out your pen, pencil, register. As I've already told you, it is important that if you are going to actually write, then definitely it will hold you in a very good state. Significant points. As a professional student, you need to be well aware of all these points before you are able to understand all these formidable chapters like Ind As 103 and Ind As 103, Ind As 110. Correct? So, in order to explain the significant points, first of all, just have a look over here. I presume that there is an entity by the name of E1. Correct? I further assume that this entity has made some investments in equity instruments or equity shares of S1 Limited. So there is an entity by the name of E1 Limited, and we are presuming that this particular entity has made some investments in what we call S1 Limited. Number one. We further presume that the investment is in the range of 1% to 19.99%. The investment of this particular entity in this particular entity S1 is in the range of 1% to 19.99%. You can presume any figure, 7%, 8%, 9%. Actually, the point I'm trying to hammer into your mind is that actually their investment is in between 1% to 19.99%. The first thing first. In this case, first of all, as a professional student, you need to be well aware of all these things, and some of you might be already aware of. Correct? E1 will be considered as investor entity. First of all, you must understand that the entity E1 will be considered as investor entity, and the entity in which we have made the investment will be considered as an investee entity. Investee entity. So if an entity has invested in the other entity will be considered as investee entity, while the entity which has made the investment will be considered as investor entity. And if our investment are in the vicinity of 1% to 19.99%, then it will be presumed as simple normal investment. So these investments will be considered as normal investment. These investment will be considered as normal investment. So these are the basic points which you need to understand. So these will be considered as our normal investment. If my investment in other entity is 7%, 8%, 9%, 11%, 18%, 19%, then these will be considered as normal investment. And the important point is that in this case, the investor entity is going to account its investment in the investee entity because investor entity has made some investment in the investee entity. So investor entity will account its investment in the investee entity in its individual balance sheet, in its separate financial statement. So investor will account, this is the point which you need to understand. Investor will account investments Investor will account investments in investee entity, in its separate financial statement or individual financial statement, you can also write, in its separate financial statement as per Ind As 109. So in accordance with Ind As 109, they are going to account the investment as per Ind As 109. So whatever investment which we have made in the investee entity, correct, in our separate financial statement towards asset side, I am going to write investment in investee entity in accordance with Ind As 109. It means I am going to record the investment at fair value, because Ind As 109 states that the investments must be recorded at fair value. This is the important point, and this is the first point which you need to understand as a professional student. Obviously, if my range of investment is in between what we call 1 to 19.99%, in this particular case, I need not require to prepare consolidated balance sheet. In this case, no consolidated financial statements are required. When I'm writing CFS, CFS here doesn't stand for cash flow statement, rather consolidated financial statement. So in this case, investor entity need not require to prepare any consolidated financial statement. It will only record the investment which it has made in the investee entity in its separate financial statement. This is the first point. Is it clear to you? Now, second point is that now we presume there is another entity by the name of E2. Once again, this particular entity, let us say, has made some investment in the equity shares. Investment in equity shares, let us say, of S2 Limited. So this time, as E2 Limited has made some investment in other entity, that is S2 Limited. But this time, the range of investment, we presume their range of investment, correct, the range of investment is 20% or more. The range of investment is 20% or more, 20% or more, but up to 50%, up to 50%. Suppose I have made some investment in the other entity and I have purchased 30% equity shares of the other entity, correct? So this 30% is falling in the range of 20% to 50%. So that means if an entity makes investment in the other entity and the range of the investment is 20% or more, but up to 50%, in this particular case, we may say that investor entity is exercising significant influence over the other entity, correct? Investor entity is exercising significant influence, because this time we have investment in the vicinity of 20% to 50%. So whenever an entity would have investment in the vicinity of 20% to 50% in the other entity, in that case, we may say that investor entity is exercising significant control. So significant control. Significant influence, in fact, you write. Significant influence, what does it mean? Significant influence means investor entity can participate in the what we call financial matters and the what we call other matters of the other entity. That is what we mean by significant influence. So in the financial and operational matters, we are having a bit of influence simply on account of stakes which we are holding of the other entity. Obviously, once again, I need not require to tell you, in this particular case, E2 entity will be considered as investor entity because this entity has made the investment, correct? And time and again, I need not require to tell you anyway. So E2 is the investor entity. S2 is the investee entity. No doubt about that. No doubt about that. By now, you are well aware of investor and investee. But the important point is that this time our investment range is 20% or more, but up to 50%. Because our investment is pretty high, so we are exercising significant influence over the other entity. And when we are exercising significant influence over the other entity which is investee entity will be considered as an associate entity. So this time S2 will be considered as an associate entity of E2. Is it clear to you? It will be considered as an associate entity of investor entity. So we may say that S2 in this particular case is an associate of E2 entity. Why? Because we are having a significant influence. How we are exercising the significant influence? Because we hold what we call more than 20% or more, but up to 50% investment in the investee entity. Is it clear to you? Now, the other important point is that in this case, the investor entity, as I told you, as far as accounting aspect is concerned, in this case, investor entity will have to account its investment in the associate. Investor entity will account investment in associate. Investment in associate. The investor entity will account investment in associate in its separate financial statement. In its separate financial statement as per Ind As 27. As per Ind As 27. That means whatever investment which I have means the investor. So whatever investment investor entity has made in the associate entity, the investor entity is going to put that investment towards the asset side in its separate financial statement, but as per Ind As 27. But what exactly Ind As 27 states? Ind As 27 states that investor entity can record the investments either at cost or at fair value. So it is the prerogative, it is a choice of the investor entity. They can record the investment either at cost or they can record it at fair value, because Ind As 27 provides a choice and discretion to the, as I told you, investor entity to record the investment in accordance with Ind As 27, and Ind As 27 states that you can put the investment either at cost or at fair value. It is your prerogative. Is it clear to you? So whatever investment which we have made, we are going to record it in our separate financial statement, number one. And besides that, investor entity in this particular case will have to prepare a consolidated financial statement. So investor entity will also prepare consolidated financial statement. Investor entity will prepare consolidated financial statement. Is it clear to you? And consolidated financial statements will be prepared in accordance with, that is also very important, in accordance with Ind As 28. So in this case, as you must have noticed, because you are exercising significant influence over the other entity, and other entity is your associate entity. So if other entity is an associate, in that particular case, the investor entity will have to prepare two sorts of what we call financial statement, one separate financial statement, and besides that, consolidated financial statement. Separate financial statement will be prepared in the light of Ind As 27, wherein we are going to record the investment which we have made in what we call associate entity. The investment will be recorded either at cost or at fair value in accordance with Ind As 27, and besides that, we shall have to prepare consolidated financial statement, and we shall prepare the consolidated financial statement as per Ind As 28. So these are the important significant points which most of the students, which I have seen actually through my experience, that is student fraternity, never pays any attention. And lots of MCQs were recently asked from what we call even such topics. So that's the reason you need to be well aware of these significant topics. Then we can move over to the next part, C. Once again, in this particular case, I consider that there is an entity by the name of E3. Now, this particular entity, once again, we presume has made some investments in equity shares. I do not know how many among you are writing, although all these points I have written in my notes, but still I would love you to make a habit of writing. Investment in equity shares. So this time E3 entity has made some investment, and the investment has been made in equity shares of, let us say, S3 Limited. Is it clear to you? We presume that in this particular case, the range of the investment is more than 50%. More than 50%. This time we have acquired, let us say, more than 50% stakes in S3 Limited. More than 50%. More than 50% and up to 100%. So if our range of investment in the other entity is more than 50% and maximum it could be up to 100% only. So if your range of investment in the other entity is in between 50% to 100%, obviously, as you know better than I, in this case, we may say that investor entity is having control over the other entity. So this time you are having a control over the other entity because your range of investment is more than 50%. So obviously now the other entity is under your control. That means you have got complete control over all the affairs of the other entity. So you are exercising control over the other entity. No doubt about that. Other entity is investee entity. No doubt about that. As you know, S3 will be considered as investee entity without an iota of doubt. S3 is your investee entity. But besides that, because this entity is under your control, it is also known as, and you are also aware of it, it is also known as subsidiary company. So this time S3 will be considered as your subsidiary company, or it can be also called as acquiree company. Acquiree company because you have acquired the control over this particular entity. So this entity will be considered as investee entity, subsidiary entity, or acquiree company. ACQIREE, acquiree company. While E3 entity is your investor entity, you know better than I. Investor entity, E3 is your investor entity without an iota of doubt. However, this time the investor entity will be considered as parent entity because this time you are having a control over the other entity. So E3 will be labeled as or tagged as parent entity or holding entity. It is also known as holding company or parent company. Or you can simply term it as an acquirer entity because you have acquired the control over the other entity. Acquirer entity. So this time you are having a control over the other entity. Why you are having a control? On account of majority stakes. Because you are having more than 50% stakes in the other entity. Obviously you are having the majority stakes, and that's the reason why you are controlling the other enterprise. Now in this particular case, as far as accounting aspects are concerned, the investor entity will have to prepare, similar to the last case, investor entity will have to prepare separate financial statement and consolidated financial statement. We saw that when we were having an associate, even in that particular case, we were preparing separate financial statement and consolidated financial statement. Similar to this one, this time we are having a subsidiary or acquiring company simply because of the fact that we are having a control over this particular enterprise. So the investor entity will account investment in acquiring company or investment in subsidiary company, whatever you may like to write. Investment in acquiring company will account investment in acquiring company in its separate financial statement, correct? In its separate financial statement in accordance with Ind As 27. In accordance with Ind As 27. In accordance with Ind As 27. And I have already explained the provisions of Ind As 27. Ind As 27 states that you can record the investment either at cost or at fair value. Correct? So you will record the investment which you have made in the acquiring entity or subsidiary entity in your separate financial statement as per Ind As 27. Number one. Besides that, the investor entity will have to prepare consolidated financial statement. You will have to prepare the consolidated financial statement. But the important point is that this time the investor entity will prepare the consolidated financial statement on the date of acquisition. On the date of acquisition means the date on which you have acquired the control over the other enterprise, correct? So on the date of acquisition, DOA means date of acquisition. So you are going to prepare, you means the investor entity are going to prepare a consolidated financial statement, as I just said. So the consolidated financial statement will be prepared on the date of acquisition, but on the date of acquisition, when you are going to prepare the consolidated financial statement, you are going to prepare it in accordance with Ind As 103. This is the most important point, and I have seen actually most of the students are always under a confusion when Ind As 103 applies and when Ind As 110 applies. So, on the date of acquisition, you are going to prepare the consolidated financial statement by applying the provisions of Ind As 103. Is it clear to you? However, at the same time, on the date of acquisition, you are going to prepare the consolidated financial statement. Besides that, you are going to prepare the consolidated balance sheet, consolidated financial statement at year end and subsequent year end. At year end and subsequent. That means after the date of acquisition, whensoever you are going to prepare the consolidated financial statement, then year end and subsequent. Year end and subsequently. So, consolidated financial statement on the date of acquisition will be prepared by applying the principles of Ind As 103, but after that, whensoever we are going to prepare the consolidated financial statement, in that particular case, we are going to prepare it as per Ind As 110. As per Ind As 110. Is it clear to you or not? This is the important point which as a professional student, you need to know. Is it clear to you or not? Clear? I hope that till up to whatever we have written and whatever we have discussed, each one of you are getting it into the groove. And now we move over to the next point. In this point, I presume that there is another entity by the name of E4. Correct? This entity E4. And this entity has got some stakes, whatever percentage, 10%, 20%, 30%, you can presume anything. This entity has some percentage or stakes in a joint arrangement. In a joint arrangement. In a joint arrangement. What is a joint arrangement? Sometimes what happens actually, two or more than two enterprises actually, they simply actually form a sort of group and they tell to each other that combinedly we are going to work and we are going to make an arrangement. So an arrangement, you can simply say it is a collaborative effort of different entities. So different entities sometimes combine together to work upon a business idea. That is known as joint arrangement. But the important point is that joint arrangement may be formal or informal. Joint arrangement may be formal or informal. Joint arrangement could be formal or informal. It could be formal or it could be informal. Informal. When we say it is a formal arrangement, indirectly then it is known as this joint arrangement will be considered as a joint venture. Then it is considered as a joint venture. If it is a formal, that means everything is documented, everything is done in a legal manner, and generally these 3-4 enterprises combinedly have formed a new entity, a corporate entity. Correct? So that is why it is known as a formal, what we call joint arrangement. So formal joint arrangement is known as joint venture. It is known as joint venture. Whereas if it is informal, generally in case of informal, no corporate enterprise will be formed. Correct? They will simply have an agreement that we are going to work together. So it is an informal. So if joint arrangement is informal, in that particular case, it is known as joint operation. Then it is known as joint operation. Then it is known as joint operation. Is it clear to you or not? Is it clear? Absolutely clear. Now, just to elaborate the point, same point, we presume that this entity E4 is having some stakes, 10%, 15%, 20%, 30%, some stakes in a joint arrangement, and joint arrangement is a joint venture. Joint arrangement is a joint venture. Indirectly, it means this joint arrangement is a formal one, and that is why it is known as a joint venture. So if E4 is an investor and it is having some share or some stakes in a joint venture, you can say, so in this case, the investor entity will again have to prepare two types of financial statements. Correct? One separate financial statement and consolidated financial statements. So E4 will prepare separate financial statement and also consolidated financial statement if it is a case of joint venture. In the separate financial statement, E4 enterprise will account the investments in joint venture, investment in joint venture as per Ind As 27. As per Ind As 27 means they will record the investment either at cost or at fair value as per Ind As 27. As per Ind As 27. Correct? So in the separate financial statement, they are going to record the investment in the joint venture in the light of Ind As 27, that is either at cost or what we call at fair value. And besides that, they will have to prepare a consolidated financial statement, but the consolidated financial statement will be prepared as per Ind As 28. It will be prepared as per Ind As 28. This is the point. So these are the points which you should be aware of. Now we presume that E4 enterprise has some percentage or some stakes. E4 enterprise is having, let us say, some stakes in a joint arrangement, but joint arrangement this time is a joint operation. That means it is not a formal one. I've already told you, if it is a formal one, then it is known as joint venture, and if it is an informal one, then it is known as joint operation. So if it is a case of joint operation, in this particular case, investor entity will prepare only separate financial statement and no consolidated financial statements are required. Correct? So E4 entity will prepare only separate financial statement, and in the separate financial statement, obviously it is going to account its investment in joint operation, correct? But investment in joint operation will be recorded as per Ind As 111, as per Ind As 111, as per Ind As 111. And Ind As 111 states that investment will be recorded through equity method. What exactly we mean by equity method, that we will talk about later on. But at this moment, it is suffice to say that accounting in the separate financial statement will be done, number one. And in the separate financial statement, you are going to record the investment in the light of Ind As 111. Is it clear to you? I've already told you, in this case, no CFS is required. No consolidated financial statements are required. So this is the point which you need to take care of. Another important point is that this is the first significant point which we talked about. Over there, I took 4 cases. Is it clear to you? Now we move over to the next part of this particular chapter. Another important point is that you need to understand the meaning of control. Control. Just a moment ago, I told you that you are able to get the control over the other enterprise when your investment are in the vicinity of more than 50%, correct? So if you have 70% stake, 60% stake, 55% stakes in the other entity, quite obviously we may say that you are having the majority stakes in the other entity, and quite obviously in this particular case, I need not require to tell you that you are having the control, isn't it? But still, in spite of that, you need to know the meaning of the control quite well. By now, you are well aware of this, that we can acquire control through majority stake, but control can also be acquired through some other methodologies. So control can be acquired, control can be acquired, control can be acquired, control can be acquired, control can be acquired. Control can be acquired by the investor entity in the other entity. Either. One way of getting the control is by having majority stakes. So control can be acquired by way of majority stakes. And when I say majority stakes, that means more than 50% stakes in the other entity by way of majority stakes. So we can get the control over the other enterprise if we are having the majority stakes. Majority stakes means more than 50% stakes, majority stakes. This is one way of getting the control over the other enterprise. honestly speaking, most of the time you are going to have the control over the other enterprise on account of what we call majority stakes, no doubt about that. However, actually most of the students are under a perception actually that control can be acquired only when we are having the majority stakes. Now, you can also get the control over the other enterprise by way of agreement. By way of agreement. By way of agreement. By way of agreement. So you can also get the control over the other enterprise by way of agreement. So what we mean by way of agreement, I'm explaining. You can get the control over the other enterprise by way of agreement, and even under it there are two situations. Situation 1, when investor entity has the right of composition of board of directors of other entity. So when investor entity is having the right to compose the board of directors of the other entity, even in that case, we may say that investor entity is having the control. Investor entity has the right of composition of board of directors of other entity, of investee entity. I will explain it this way around. We presume that there is an entity by the name of A1, and we presume that A1 has invested in 15% equities, in 15%, correct? A1 Limited has acquired 15% stakes, let us say, in A2 Limited. I need not require to tell you, in this particular case, on account of what we call your majority stakes, on account of your investment, you are not having the majority stakes. So logically, because in this case, you are simply having 15% stakes in A2 Limited. So quite obviously, in this case, A2 Limited is neither your what we call associate entity, neither it is your subsidiary company. Isn't it or not? Because you are not having the control over the other enterprise, neither you are having any significant influence over the other enterprise. However, let us say there is an agreement. When this entity made the investment in A2 Limited, simultaneously A1 Limited and A2 Limited entered into an agreement, we presume for a while, wherein A1 was given the right, correct? So as per the agreement, let us say A1 was given the right to compose the board of directors. A1 given the right, sometime in practical life such sort of what we call agreements take place. A1 given the right to compose board of directors of A2. Compose board of directors of A2. So in spite of the fact that you are not having what we call more than 50% stakes in the other entity, in spite of that, it will be considered that you are having the control over the other enterprise. So, and if you are having the control over the other enterprise, then other enterprise will be considered as acquiring entity, and you will be considered as an acquirer entity. Is it clear to you? So you must have seen actually that control can be acquired. Besides the majority stakes, we can also get control when such sort of what we call agreements take place. So there could be another sort of agreement. When investor entity has the right, correct? When investor entity has the right to, right or power to dictate the relevant activities of investee entity. of investee entity. Correct? Presuming that there is an entity by the name of A1 and A1 has investment of, let us say, 30% in A2. Because we are having only 30% investment in A2, obviously we are not exercising control over the other enterprise. That's a different matter that we are exercising a bit of significant influence, correct? But we are not exercising the control. But let us say there is an agreement whereby A1 was given the right, correct, to dictate or to control all the relevant activities. When we say relevant activities, it means all such activities which are basically responsible for fetching the returns. And generally when we say relevant activity, it means the financial and operational activities. So we have got the control over the what we call to dictate the relevant activities. So if we have got such sort of right, even in that case, it will be presumed that we are having the control over the other enterprise. Is it clear to you or not? Is it clear to you? Okay, so we presume that you are by now well aware of all these things. Is it clear? So fine. So till up to this particular point, if everything is clear, now we move over to the other part. What is the other part? 3. Obviously, now we are in a position to understand what we mean by business combination. Business combination. Everything I have written. Logically, you need not require to write anything, but in spite of that, I would love you to actually write each and everything. That helps you a lot, not only what we call in learning the subject quite well, but also in what we call understanding the art of writing. So business combination. So by now, we have seen the what we call some significant aspects, and now we are in a position to understand business combination. What we mean by business combination, correct? In order to make you understand, and I have a habit of what we call giving lots of examples, so obviously, I will make you understand that this way around. We presume that there is an entity by the name of A1. Is it clear to you? We further presume that this entity has acquired 70% stakes in A2 Limited. In A2 Limited. Is it clear to you? We further presume that we acquired 70% control or 70% stakes on 1/7/2027. On 1/7/2027, we acquired 70% stakes in this particular entity. Obviously, when I'm going to acquire some shares or whenever I'm going to make some investment in the other entity, quite obviously, I will have to churn out some duffs, some money, correct? So let us say we acquired 70% stakes by paying rupees 7 lakhs. So this amount which we have paid to acquire 70% stakes is known as purchase consideration. Obviously, we are not going to get 70% stakes free of cost. We will have to churn out some money to get what we call 70% stakes. So we have acquired 70% stakes in this particular entity. So what we mean by business combination now? So business combination in simple words, when an entity acquires control over the other entity, correct? And you are able to get the control over this particular entity because you are having the 70% stakes. Is it clear to you or not? Obviously, I have already told you in this particular case, because now you are having the control over the other enterprise, correct? You will be considered as parent company or holding company or acquirer company, correct? So when acquirer obtains the control over the other entity, then it is known as business combination. So, and you will be called as an acquirer entity because in this chapter, instead of using the word parent or holding, we will use more often than not acquirer entity. While A2 Limited, which is under your control, logically is an investee entity or it is your subsidiary entity and acquiree entity, because now you have acquired the control over this particular entity. Is it clear to you or not? This is what we mean by business combination. First of all, you need to understand this. So what do you mean by business combination? Business combination, when does it comes into play? So when an entity acquires the control over the other entity, then it is known as business combination, and the entity which is getting the control over the other enterprise is known as acquirer entity, while the other entity is known as an acquiree entity. Is it clear to you or not? Obviously. Well, then we move over to the other part of this particular chapter. The next part is accounting aspects. Obviously, ultimately, we are more concerned with accounting of business combination. So how the accounting is done, this is the important part. Now, slowly and gradually and steadily, now we are moving into the groove. Accounting aspects. Accounting aspects. So what exactly accounting aspects we mean by here? Accounting aspects. Correct? Accounting aspects. So, suppose you have acquired the control over the other enterprise. As I just told you, let us say you acquired 70% control, you paid an amount of rupees 7 lakhs, so you are the acquired entity. Now you will have to do the accounting, correct? And this standard, Ind As 103, which deals with business combination, states that accounting will be done in the books of the accounting acquirer, correct? Accounting aspects. Ind As 103, Ind As 103 states, as I just told you, Ind As 103 states that accounting for business combination, or simply accounting will be done in the books of see here what I am writing, in the books of accounting acquirer, in the books of accounting acquirer. Standard says that accounting will be done in the books of accounting acquirer. As per acquisition method. So basically, Ind As 103 prescribes acquisition method of accounting, and it states that accounting will be done in the books of accounting acquirer. What we mean by that, actually? Before we dwell upon that, so as far as accounting aspects are concerned, whenever you are going to do the accounting, correct? As I told you just a moment ago, let us say A1 has got 70% stakes in this particular entity. Important point is that the investor entity, because A1 is investor entity, you know why? Because it is making an investment in the other entity, it is acquiring 70%. Technically, when I am saying it is an acquirer entity and it is an acquiree entity, it means from the legal perspective, A1 will be considered as an acquirer entity, while A2 will be considered as legal acquiree company. Correct? When we use the word acquirer and acquiree, generally we are using it in the parlance of legal. Correct? That means from the legal perspective, we may say that A1 is actually acquirer entity while A2 is acquiree entity. From the legal perspective. But when we are going to look into this particular sentence, what we saw actually, the standard says that accounting will be done in the books of accounting acquirer. Actually, there is a difference between legal acquirer and accounting acquirer. We will talk about that. So when we are going to do the accounting, your first step is identification of accounting acquirer. This is your first and most prominent step. Identification of accounting acquirer. Identification or determination. Identification of accounting acquirer. Identification of accounting acquirer. This is your first step, identification of accounting acquirer. And this is pretty hard to grab. Remember one thing, I have seen actually lots of student fraternity never understand this the way it should be understood. Correct? So just pay attention over here. I will try to actually make it absolutely as clear as possible. How to identify in whose books the accounting will be done. Suppose I say there is an entity A1, and A1, let us say, has made some investment in A2 Limited. Entity A1 has made some investment in A2 Limited. We also presume that investments were made on some investments were made. How much investments were made, I will let you know later on. Let us say in the balance sheet of A1 Limited, share capital given is share capital of A1 Limited is 60,000 shares. 60,000 shares of 10 each. 60,000 shares of 10 each. 60,000 shares of 10 each. Correct? We presume that this balance sheet is on 31st of 3/27. On 31st of 3/2027, in the balance sheet towards the liability side of A1 Limited, there is share capital of 60,000 shares of 10 each. In simple words, A1 is having share capital of 60,000 while A2 is having a share capital of, let us say, 50,000 shares. A2 is having a share capital of 50,000 shares of rupees 10 each. Of rupees 10 each. Correct? Of rupees 10 each. Of rupees 10 each. This is the share capital of A2. Is it clear to you or not? Just wait, let me set the mic away a bit. So this is the share capital of A2, this is the share capital of A1. Now we further presume, correct, that we further presume on 1/4 very next date. This is the balance sheet date 31st 3/2027. So on 1/4/2027, very next date, A1 acquires 70% stakes. 70% stakes. Very next day, this is the balance sheet date 31st 3/2027. And the very next day, A1 Limited acquires 70% stakes in A2 Limited. In A2 Limited and discharged purchase consideration of rupees 7 lakh. That means in order to acquire 70% stakes, A1 Limited delivered 7 lakh rupees of purchase consideration in cash. The PC was delivered by way of cash. Is it clear to you or not? So this is the situation, correct? Now in this question, first of all, you let me know who is the legal acquirer and who is the legal acquiree. It is very simple to answer. Because A1 is making the investment, so quite without any doubt and quite obviously, A1 will be considered as legal acquirer. A1 will be considered as legal acquirer. It is very easy to determine legal acquirer. There is no problem in it. Because A1 is getting the control over the other enterprise, it is acquiring what we call, it is purchasing the stakes in the other entities. So quite obviously in this case, A1 is legal acquirer and A2 will be considered as legal acquiree. Legal acquiree. But problem is that the standard says that we are not concerned with, the standard says that for accounting purpose, we are not concerned with the fact that who is legal acquirer or who is legal acquiree. The standard says that we are interested in knowing actually who is the accounting acquirer. This is the problem. So actually, to be very honest with you, in practical life, 99.99% the legal acquirer itself will also be the accounting acquirer, to be very honest with you. But still, you need to understand, because you are at professional level, you need to understand every nitty and gritty. Is it clear to you or not? Ultimately, you have to enter into the practical arena, and over there you are going to face a sort of situation a lot. So that's the reason you need to equip yourself right from the beginning, from here itself. So how to determine that who is going to be the accounting acquirer? In order to determine the accounting acquirer, first of all, you need to understand the meaning of the group, correct? If suppose I'm going to ask you in this particular case, first of all, you need to understand a group means actually either the investor entity is having an associate or it is having a subsidiary company, then only a group can come into play. In this case, because you have acquired 70% stakes in A2 Limited, quite obviously A2 Limited is your subsidiary company or acquiring company. So I would say that in this case, the group comprises of A1 Limited, the acquirer entity, and A2 entity. A2 is your acquiring entity. In the group, these two entities will combinedly be called as a group. Is it clear to you or not? Now my next question is, what is the share capital or number of shares of the group? Total number of shares in the group. If I am going to ask you this question, total number of share in the group, total number of shares in the group, total number of shares in the group, total number of shares in the group. If suppose I am going to ask you this question, correct? Let me know the total number of shares in the group. What will be your answer? Some of you may be tempted to say, sir, 60,000 is the number of shares of A1 Limited and 50,000 is the what we call number of shares of A2 Limited. So total number of share will become 1,10,000. So quite obviously, total number of share in the group must be equal to 1,10,000. As I've already told you, because some of you may think actually 60,000 is the total number of shares of A1 Limited and 50,000 is the total number of shares of A2 Limited. So some of you may tempt to say actually that total number of share of the group is equal to 1,10,000. No. Total number of shares, whenever we are going to check the total number of shares of the group, we will always, I'm telling the first and last time, we will always take the total number of shares of legal acquirer, total number of shares of legal acquirer. That means whenever you are going to compute the total number of shares in the group, you will consider only legal acquirer share, legal acquirer's share. And we know that legal acquirer is A Limited and A Limited is having 60,000 shares. So quite obviously the total number of shares in the group will be considered as 60,000. But here again, some of you may tempt to say, some of you may think, actually, some of you, I'm not telling every one of you, because sometimes confusion arises. So that's the reason I want to erase out every confusion. Some of you may think actually that A2 Limited is having total shares 50,000. As I've already told you, total number of shares of A2 is equal to 50,000. And it is given that we have acquired 70% of the shares of A2 Limited. So that means we have acquired 35,000 shares of A2 Limited. So some of you may think actually 60,000 shares we are already having and we have acquired 35,000 shares. So our total share capital is equal to 95,000. Some among you may think actually on such line, isn't it or not? Some of you may think on such line, and that's the reason actually then it will become a problem. So you need to understand, because I want to clarify, I know actually what sort of doubt actually crops up in the mind of the student fraternity, and that's the what we call benefit of nearly 4 decades of experience. So first of all, you need to understand, without an iota of doubt, your version is not wrong or not out of place, but try to understand, you are A1 Limited, you are having 60,000 shares. When you are acquiring 70% stakes in the other entity, you will not put it up towards your liability side. Whatever investment which you are making, you are going to put up in your asset side. So it will not affect your share capital. The 35,000 shares which you have acquired, you are going to put it up towards your asset side. So that is the reason in this particular case, you need to actually understand. Just wait actually. I think this mobile got. So that's the reason actually. Your share capital will remain unchanged even though you have acquired 35,000 shares, because you are going to note down the investment in the investee entity towards your asset side. So that is the reason all such doubt should not be there. Is it clear to you or not? So that is the reason total number of shares of the group will be considered as 60,000. Number one, total number of share of the group is 60,000. Is it clear to you? Now, once you have determined the total number of share in the group, time and again I'm telling you, in order to know the group's total share, you will take into account the number of shares of the legal acquirer. Correct? Now, we may say that in the group there are 60,000 shares and all these shares are held by, now you will check how many shares are held by A1 Limited. Quite obviously, all these shares are held by A1 Limited. And how many shares among these shares are held by A2 Limited? Quite obviously, A2 Limited is not having any shares out of these 60,000 shares. So, because this is the total number of share of the group and 100% of the shares are in our hand, so we may say that in the group control is in our hand, so we are considered as an accounting acquirer. So that is the reason we will be considered as an accounting acquirer. Is it clear to you or not? How you are going to determine who is the accounting acquirer? So you need to understand this particular art. Is it clear to you? I will give you some more example. Correct, I know that this will not clarify the point, and unless and until I'm very sure that things are absolutely clear, I'm not going to move forward. Let me give you another example. Almost the same example. Once again, this is your second example of determination of accounting acquirer. Once again, I presume that this is the date 31st of 3/2027. This is the date 31st 3/2027. On this date, in the balance sheet of A1 Limited, towards the liability side, share capital is, let us say 60,000 shares once again. 60,000 shares of 10 each, similar to the last question or last example. And this is the balance sheet of A2 Limited, correct, on 31st of 3/2027, and their share capital once again is 50,000 shares of rupees 10 each. And similar to the last question, we presume that on 1/4/2027, A1 Limited, A1 acquires 70%, A1 acquires 70% stakes in A2 Limited, and discharged, now pay attention here, you will understand it now better, and discharged consideration of 7 lakh and discharged consideration of rupees 7 lakh through shares. Last time we made the payment of purchase consideration through cash, but in this case now I have written that purchase consideration was discharged by A2 Limited through shares of rupees 10 each. That means in order to discharge the purchase consideration, A2 Limited must have issued 70,000 shares of 10 each. Isn't it or not? So in this case, you need to understand, and I need not require to tell you because A1 is acquiring or investing in the other entity. So A1 is the legal acquirer and A2 is the legal acquiree without any iota of doubt. But we need to find out who is the accounting acquirer. And in order to find out the accounting acquirer, what you need to do, first of all, you write here group's number of share. So group's number of share, I have already told you, in order to know the number of share of the group, first of all, you coolly find out who is the legal acquirer. A1 is the legal acquirer. And the share capital of A1 is 60,000, it is given. Share capital of A1 is 60,000, correct? It is 60,000. But you should not forget in this particular case that you means the A1 Limited is issuing 70,000 shares. When A1 Limited will issue 70,000 shares to discharge the consideration, its number of share will move up. So 70,000 shares we are issuing, so our share capital will go up. Are you getting my point or not? Because this time we are discharging the purchase consideration through issue of shares. So because of that, our share capital will increase. So earlier we were having the 60,000 share capital as issued capital. Now we have issued 70,000 more share. So our total number of shares will be equal to 1,30,000. So in this case, we may say that group's share capital is 1,30,000 shares of 10 each. Is it clear to you? Now you pay attention. In this case, what is happening? Out of 1,30,000, suppose if I would say, how many shares are held by A1 Limited? Now, out of 1,30,000, A1 is having how many shares? Are you holding upon 1,30,000 shares? No, because out of 1,30,000 shares, you are having in your hand only 60,000 shares. Because 70,000 shares you have issued to actually A2 Limited. So 70,000 shares are being held by A2 Limited. So you must have noticed here in this particular case, A2 Limited is having 70,000 shares this time. Out of 1,30,000, 70,000 is in the hands of A2 Limited. Because more than 50% of the group share capital is in the hands of A2 Limited. So in this case, A2 Limited will be considered as an accounting acquirer. So this time, A2 Limited will be considered as accounting acquirer. That means the beauty of Ind As 103 is that even legal acquiree can be considered as acquirer for the purpose of accounting. So whenever in practical life, legal acquiree becomes acquirer for accounting purposes, it is known as a case of reverse acquisition. Reverse acquisition, and we have kept a separate section wherein we are going to do lots of questions with respect to reverse acquisition. It is known as reverse acquisition. So by now you must have understood actually why this particular step, determination of accounting acquirer, is quite vital. So this is a pretty vital what we call step. Correct? This is the first step in the entire accounting. But to be very honest with you, I've already told you, correct? 99.99%, the legal acquirer itself will be the accounting acquirer. However, very rarely it happens when a case of reverse acquisition takes place. That means when legal acquiree becomes the accounting acquirer, very rarely it happens. It never happens frequently. Remember one thing. Is it clear to you? Now, coming over to the next point, we were discussing the accounting aspects. As I told you, the first step is identification of the accounting acquirer, and I hope by now actually you are feeling a bit of confidence to determine, correct, the accounting acquirer. Now we move over to the next part of the game. The next part is, in order to do the accounting on the date of acquisition, correct? On the date of acquisition, you have determined who is the accounting acquirer. Now, the next thing is determination of purchase consideration. Determination of purchase consideration. Determination of purchase consideration. Determination of purchase consideration. First of all, what we mean by purchase consideration, I have already told you, purchase consideration is the amount which is paid by the acquirer entity to the acquiree entity against what we call the investment which they have made. Actually, PC, purchase consideration means, purchase consideration simply refers to the amount paid or payable by acquirer entity to the owners of acquiree entity. This is what we mean by basically purchase consideration. Because against acquisition of some stakes in the acquiree entity, you will have to make some payment that is known as purchase consideration. Honestly speaking, the amount of purchase consideration is generally given in the question. It will be very clearly and comprehensively given in the question itself. But concept-based question could be asked wherein you may be asked to compute the amount of purchase consideration. Generally, in the long question, it will always be given. But still, you should know. Purchase consideration is sum of. Purchase consideration is sum of. Purchase consideration is sum of. Purchase consideration is sum of cash. Suppose, because purchase consideration can be paid by way of cash or any asset. You can also deliver asset to discharge the purchase consideration. Fair value of equity shares. You can issue equity shares to discharge the purchase consideration. Fair value of debentures. Fair value of debentures. Then we use a word, contingent consideration. fair value of contingent consideration. Contingent consideration. Contingent consideration. Contingent consideration. Then fair value of deferred consideration. Deferred consideration. Deferred consideration. I have already told you, generally in the long questions, you will always be given the amount of purchase consideration. However, some concept-based question may be asked, wherein you may be asked to actually compute the amount of purchase consideration. So, whatever payment you are making to the acquiring entity against your investment, that is known as purchase consideration, and purchase consideration can be delivered in any mode, in cash or assets or equity share, debenture, etc. But here 2 points are important: contingent consideration and deferred consideration. What we mean by contingent consideration and what we mean by deferred consideration. Again, we have kept a very separate section. Correct? Those among you who have already received our books, you must have seen actually we have divided the entire chapter section wise. Correct? A particular section comprises of particular question. So there is a section on deferred consideration and what we call contingent consideration, where we have kept some concept based question, but still just to make the point a little bit clear. We presume, correct, there is an entity E1. It acquires the control over E2 by acquiring 70% stakes, correct? When E1 will acquire 70% stakes, obviously we are having the control and we are going to make some payment. When we are going to acquire 70% share, obviously we are going to make some payment to the other entity, the investee entity. But generally in practical life, sometimes such sort of agreement take place. What sort of agreement? For example, E1 tells to E2 Limited that we are going to pay you this much of amount today itself, the date on which we are actually going to get 70% stakes. Besides that, we will pay you, let us say, 20 lakhs more rupees. We are going to pay you 20 lakhs more, but after 2 years. We will pay 20 lakhs more after 2 years. After 2 years. But there is a condition. We will pay you 20 lakhs after 2 years only if you means the acquiring entity will deliver us a profit of 2 crores. Remember one thing, you have got the control over this particular enterprise. That doesn't mean the existence of this particular enterprise has come to an end. This entity will keep on functioning, but only thing is that it will function under your direction, under your control. Correct? It is a different entity. Don't actually let it escape out of your memory. Most of the students sometimes think actually when we get the control over the other enterprise, the entire existence of the other enterprise comes to an end. No, that is not the case. It will keep on functioning. So here what is happening actually, on the date of acquisition, we are telling to this particular entity that we are going to pay on this particular date so much of amount. But besides that, we assure you that we will pay you 20 lakhs more, but after 2 years. But this payment will depend. Depend means it is contingent. That is why it is known as contingent consideration. Contingent consideration means this consideration, payment of this consideration is dependent upon the fact whether the condition would be met or not. So if this condition would be met, after 2 years, we are going to make the payment. And if this condition is not going to make, we are not going to make any payment. This is what we mean by contingent consideration. Another important point is that even though, as you have already seen, that 20 lakhs may have to be paid or may not have to be paid, correct? Depending upon the future course of outcome. If the target would be met, of course, then acquired entity will have to make the payment. If the target wouldn't be met, in that case, we are not going to make the payment. But in spite of that, Ind As 103 states that if you have promised some consideration, or if there is a case of contingent consideration, irrespective of its final payment, you are going to make it a part of purchase consideration. Are you getting my point or not? So I will include this payment also when I'm going to compute the total amount of purchase consideration. So whatever payment which I am going to make immediately and whatever contingent consideration payment is there, that will also be made as a part of purchase consideration. But point is that Because this payment will have to be paid after 2 years, so I will have to compute its present value. So I will have to compute its present value, and then I will include it as a part of purchase consideration. This is the point which you need to understand. And similar is the case with respect to deferred consideration. The only difference between contingent consideration and deferred consideration is that in case of deferred consideration, we simply tell to the acquiring entity that we are going to make you some payment after so much of time. But in this case, no conditions are attached. No conditions are attached. So even such payments will be considered as part of purchase consideration. And in order to determine their fair value, we determine their what we call present value. So at present value, we are going to include them. Is it clear to you or not? So that is what we mean by contingent consideration and deferred consideration. Now, coming over to the next step, step number 3, we come over to the next step. Now, next step is, because your ultimate target is that on the date of acquisition, you are supposed to prepare the consolidated balance sheet. What we mean by consolidated balance sheet? I'm A1 Limited, you are A2 Limited. I am the acquirer entity, you are the acquiring entity. I'm taking control of your enterprise. Is it clear to you? Now, I will have to prepare the consolidated financial statement, I have already told you, on the date of acquisition. And when we say consolidated balance sheet or consolidated financial statement, I will have to prepare. What does it mean? It means I will have to actually combine the assets of A1 and A2 Limited and liabilities of A1 and A2 Limited and put them in a single statement. That single statement will be known as consolidated financial statement. That's all. So I'm supposed to prepare the consolidated financial statement. But the point is that I will have to include your assets and liability also, correct, in order to prepare the consolidated financial statement. So I will have to pass the entries for taking over your assets and liabilities. And in order to take over your assets and liabilities, I will have to pass some entries, and I should be very well aware of all the rules and all the what we call facets which govern the entire panorama of what we call accounting of this particular part. So let's have a look over this. But before we start this particular point, we will take a So welcome after the break, and we have already seen as far as accounting aspects is concerned, first of all we need to determine the accounting acquirer, and then ultimately we have to find out the amount of purchase consideration. And before setting off, I also told you actually that our ultimate target is to prepare the consolidated balance sheet. And in order to prepare the consolidated balance sheet, I will have to pass some entries. And that is why your next step will be recognition, identification, and measurement of assets and liabilities taken over. Now here, let me tell you, your general rule is that, whatever, let us say this is the balance sheet of acquiring entity. Whenever acquiring entity, I will write A2, correct? General rule is that whatever assets and liabilities which are appearing in the balance sheet of the acquiring entity, you are going to actually take them over. All the assets and all the liabilities of the acquiring entity which is appearing in their balance sheet, you are going to take them over, and you are going to take them over at fair value. So all assets and liabilities of acquiring entity, correct, acquiring entity, appearing in their balance sheet, appearing in their balance sheet will be taken over and taken over at fair value. So this is the general principle, that all the assets and liabilities of the acquiring company which is appearing in their balance sheet, you are going to actually record them, and you are going to record them at fair value. And your entry will be assets account debit to liability account. Is it clear to you or not? It is as simple as that. But There are some exceptions to this particular principle. Actually, this is the general principle. The general principle is that all the assets and liabilities which are appearing in the balance sheet, you will have to take them over and you are going to record them at fair value. Now, suppose this is the acquiring entity, correct? This is the acquiring entity. And there are some liabilities, there are some assets in the balance sheet. Besides that, this acquiring entity, let us say, is having a contingent liability. It is having a contingent liability. Contingent liability. You know better than I, actually, contingent liability are basically recorded in the footnote. That means they are not recorded in the balance sheet. So if contingent liability is not recorded in the balance sheet, technically it is not a real liability. It is contingent liability. It may be a liability, it may not be a liability. That will be determined by the future course of what we call action, isn't it or not? We presume that some of the clients of A2 Limited, have put up a case against A2 Limited. So a case is going on. But A2 has recognized this disputed case as a contingent liability. A contingent liability means A2 Limited is of the opinion that probability of outflow of funds is not there. Probability of outflow of funds. Probability of outflow of funds is not there. Probability of outflow of funds is not there. So whenever there is a present obligation, what we mean by present obligation? Present obligation means the obligation on the reporting date. On the reporting date means the balance sheet date. On the balance sheet date, there is an obligation upon us, but at the same time, we are of the opinion that probability of outflow of funds is not there. So if we find that probability of outflow of funds is not there, generally it is recognized as a contingent liability. That means it is not recognized as a liability. Is it clear to you? Now, Ind As 103 states that the general principle is that all the items which are appearing in the balance sheet, you are going to record them and record them at fair value. But as an exception, Ind As 103 states that the acquired entity will also take over the contingent liability. Correct? So, contingent liability, that means acquirer entity will also take over the contingent liability. Contingent liability shall also be taken over. Contingent liability shall also be taken over. Shall also be taken over. So you are supposed to take over the contingent liability also, shall also be taken over, and recognize it. And you are going to recognize it at fair value. You are going to recognize it at fair value. So logically, if I am taking, I means the acquirer entity, if I am taking over your contingent liability, which contingent liability means which is not a liability, but I am taking it over. And when I am taking it over, it means I am going to recognize it as a liability. So that means it is a sort of loss to me, to be very honest with you, because if something which is not a liability, but if I am going to take it over, then I will have to recognize it as a liability and I will recognize it at fair value. This is what Ind As 103 states. Is it clear to you? Besides that, see, assets such as customers list, assets such as customers list, or internally developed patent, internally developed patents, not recognized by acquiring entity, shall also be taken over, shall also be recognized. When we say recognized, it automatically means shall also be taken over. Shall also be recognized. Shall also be recognized. What does it mean? What does it mean? For example, I'm taking over the control of A2. So A2 is obviously acquiring entity. Now, this acquiring entity, let us say, is a startup company. It is a startup company and it has a very strong presence in the market, correct? And it has got a customer list also. There are lots of clients, lots of customers of this particular entity. But this entity doesn't know, let us say, due to some or other reason, that customer list is also an asset. So it could be a possibility that when we are taking control of the other enterprise might have not recognized some items as an asset, but which actually are assets, especially in the light of Ind As 38, correct? So there may be some items which should have been recognized an asset, but somehow, or due to some or other reason, our acquiring company hasn't recognized them as an asset. So even such assets, standard Ind As 103 states that you are going to recognize. Is it clear to you or not? Point number D. Liabilities. Liabilities such as income tax. Liabilities such as income tax, employee benefits, EB I have written, employee benefit, shall also, I have written all these things in the notes, don't worry about that, but still I would love you to write. Liabilities such as income tax and employee benefits shall also be taken over. Shall also be taken over. Shall also be taken over and recognized as per provisions of Ind As 12 and 19 respectively. As per provisions of Ind As 12, actually Ind As 12 deals with income taxes, and Ind As 19 respectively. So if your acquiring entity is having what we call some income tax liability or employee benefits, even such liability you are going to take over, but you are going to recognize them as per the provisions of Ind As 12 and Ind As 19 respectively. Correct? Then E. Non-current assets held for sale. Non-current assets. Non-current assets. Actually, non-current assets held for sale are governed by Ind As 105. Non-current asset held for sale. Suppose if your acquiring entity has classified some of the non-current assets as held for sale. A non-current asset held for sale is one wherein we feel that without selling them off, we cannot recover their amount, their carrying amount. That means unless and until we are going to dispose them off, we are not going to recover the amount. So such items are generally categorized as non-current asset held for sale. So if the acquiring entity in the balance sheet is having some non-current asset held for sale, even such items you are going to take over, you are going to recognize, but you are not going to recognize them at fair value. You are going to recognize them at fair value less cost of sale. Non-current asset held for sale shall also be taken over. Shall be taken over and recognized at fair value less cost of disposal. Recognized at fair value less cost of disposal. FVLCOD means fair value less cost of disposal. And one more thing, indemnification assets. What we mean by indemnification asset? Indemnification assets shall also be recognized. Shall also be recognized. Shall also be recognized. Indemnification asset means sometime the acquiring entity tells you that we will indemnify you, we will compensate you. Especially it happens when acquiring entity is having a contingent liability. For example, there is an acquiring entity and it is having a contingent liability of 5 lakh. An acquiring company knows that the acquirer entity will have to assume the contingent liability also. As we have already seen that Ind As 103 states that even the contingent liability shall have to be taken over. So we will take over the contingent liability. I told you earlier, when we are taking over the contingent liability and we are going to recognize it as a liability, technically it is a loss to us. So acquiring entity will tell to A2 entity, we will have to take your contingent liability and it's a big loss to us. So acquiring entity may say, well, we promise you that in case if this liability materializes and you will have to pay some amount, then we may refund it, or let us say we will pay you 3 lakhs in case if you will have to pay this particular liability. That means acquiring entity is here giving us a promise that we are going to indemnify you, we are going to compensate you in case if you were to incur any loss on account of this contingent liability taken over. Correct? So in simple words, indemnification asset means it is the promised amount by the acquiring entity, and the standard states that any indemnification asset, in case it's there, then you will have to actually recognize it. So these are some important points. Remember one thing, the general principle is that whatever items are appearing in the balance sheet, you will have to record them, but these items are a sort of exception, you can say. Is it clear to you or not? Now, we have already seen that as far as accounting is concerned, correct, on the date of acquisition, the ultimate target is to prepare the consolidated financial statement. But for the same, first of all, we need to know who is the accounting acquirer, then what is the amount of purchase consideration, and then we will have to pass some entries. And further, the standard also says that, this is point number 4, standard states that the acquirer entity need to show the non-controlling interest. NCI, non-controlling interest. What we mean by non-controlling interest? Non-controlling interest. Non-controlling interest. Standard says that acquirer entity will have to reflect on the date of acquisition the non-controlling interest. Now what does it mean? What does it mean? Before that, let me tell you, standard also says that non-controlling interest can be computed either through PSNA approach or through fair value approach. That means the acquirer entity can reflect the non-controlling interest by adopting PSNA approach. PSNA means proportionate share of net asset. Proportionate share of net assets, or it can reflect the non-controlling interest at fair value. It is the prerogative, it is the choice, it is the discretion of what we call acquirer entity, whether they want to show the non-controlling interest through PSNA approach or through fair value approach. Now we will try to understand what exactly we mean by that. And in order to understand that, let's have a look over here. We presume that A1 is the acquirer entity and A2 is the acquiring entity. Correct? We also presume that accounting year is starting from 1/4/2027, ending on 31st of 3/2028, and we presume that somewhere here on 1/7/2027, correct, A1 acquired 70% stakes in A2 Limited, and purchase consideration was determined at rupees 9 lakh. Purchase consideration is determined at rupees 9 lakh. This is the scenario. Accounting year starts from 1/4/2027, ends on 31st of 3/2028. On 1/7/2027, we acquired 70% stakes, and in order to acquire 70% stakes, we paid a consideration of 9 lakh. Important point is that, also given in this question, net assets of A2 Limited, net assets of A2 Limited on the date of acquisition. Now, on the date of acquisition, net assets of A2 Limited is equal to 10 lakh. Is equal to 10 lakh. It is also given in the question that on the date of acquisition, acquiring company is having net assets of rupees 10 lakh. What we mean by all this statement? Now pay attention. Suppose I want to compute the amount of NCI. What we mean by that actually? What we mean by that? You must understand that first of all, you have got 70% control in this particular entity. That means the total share capital of A2 is 100%. And out of 100%, obviously A1 is having 70% stakes. You are having 70% stakes, more than 50% stakes, and that is why you are having the control over the A2 Limited. That means the rest of the 30% shareholders will be considered as other shareholders. They are other shareholders, and technically they are known as non-controlling interest. They are known as non-controlling interest holders. Why they are known as non-controlling interest holder? Because they also have made some investment in this particular entity. They have made some investment in this particular entity. That means they are having some interest in this particular entity. But only thing is that they are not having the control over this particular entity. That is why the other shareholders will be known as non-controlling interest holder. Now, when standard says that the acquirer entity will have to reflect on the date of acquisition the non-controlling interest, what does it mean? It means we need to reflect what amount of the net assets on the date of acquisition of the acquiring entity belong to NCI. What I mean by that, for example, suppose if I am going to compute NCI on the date of acquisition, correct? In this particular example, NCI on the date of acquisition, let us say as per PSNA approach, as per proportionate share of net approach, as per PSNA approach, proportionate share of net assets approach. What does it mean? First of all, I will take into account the net assets of acquiring company on the date of acquisition. Now, we have already seen that net assets of the acquiring company on the date of acquisition is 10 lakh. Because NCI is having 30% stakes in this particular entity, A2. We are having 70% stakes and other shareholders are having 30% stakes. So when we say 30% stakes, that means the other shareholder are also having a share in the net assets of the acquiring company to the extent of what we call their holding, and their holding is 30%. So, in order to compute NCI on the basis of PSNA, what I need to do, I will take into account the net assets on the date of acquisition, and I will simply multiply it with the proportion of the NCI. The proportion of the NCI is 30%. So, we may say that on the date of acquisition, total net assets of the acquiring entity is equal to 10 lakh, and out of 10 lakh, 3 lakh worth of net asset belong to NCI. That is what we mean by NCI. When standard says that the acquiring entity will have to reflect NCI, it means what is the share of net assets of NCI on the date of acquisition, which is 3 lakh. But here we have computed NCI on PSNA basis. Suppose if I would have computed NCI on fair value basis, as per fair value, in order to compute NCI as per fair value basis, what I will do? See here, whenever you are asked to compute NCI on fair value basis, first of all, you think on this manner that what is the share of acquirer entity? Acquirer entity is having a share of 70%, in the acquiring entity. And in order to acquire 70% shares, it is given in the question that you have made a payment of 9 lakh, correct? We have made a payment of 9 lakh. We have made a payment of 9 lakh to get 70% share. So we may say the fair value of 70% is equal to 9 lakh. So therefore, fair value of 30% will be equal to this much. So this is how I am going to compute the fair value. What is sometime it seems in between, extremely sorry. In the background some noise is there. Anyway, so for 70% the amount is equal to 9 lakh. So for 30% what will be the amount? Is it clear to you? So 30% into 9 lakh divided by 70%. This is how you are going to compute the amount of NCI on fair value basis. Remember one thing, it is the choice of the acquirer entity whether they want to show NCI on PSNA basis or fair value basis. Now, if I am going to take into account the value of the NCI on fair value basis, I will get, I think, something near about 385,714 approximately. Of course, when you are going to adopt fair value approach or PSNA approach, your answer will not be similar. Your answer will be different. Correct? So as per fair value approach, we may say that out of total net assets, 3,85,714 worth of asset belong to NCI on the date of acquisition, while as per PSNA approach, we may say out of 10 lakh, 3 lakh worth of net asset belong to NCI. Is it clear to you? And finally, standard also says that the acquirer company on the date of acquisition need to find out good amount of goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. Gain on bargain purchase is a term which we use, correct, as a substitute for capital reserve. Correct? So Ind As use gain on bargain purchase for capital reserve. So goodwill or gain on bargain purchase. Gain on bargain purchase. Gain on bargain purchase. It's a pretty long word. In order to compute goodwill or gain on bargain purchase, what you are supposed to do? First of all, you will take into account the net assets of acquiring entity, acquiring entity, on the date of acquisition. On the date of acquisition, we will take into account the net assets of the acquiring company. Correct? Once we know the amount of net assets, then out of that, I will have to pluck out the share of NCI. That means I will have to find out of total net assets on the date of acquisition of acquiring company, what proportion of the net asset or what worth of net asset belong to NCI. Correct? So I will take into account the NCI share of net assets, which we can determine either through PSNA approach or through fair value approach as we determined in the earlier step. So out of total net assets, we may say this much of net asset belong to NCI. So what about the remaining asset? So remaining net assets reflect the acquired share. So whatever remaining asset will be there, it shows acquired share. Acquirer's share of net assets. Acquirer share of net assets. Correct? So out of total asset, this much of asset belong to NCI, so rest of the asset will belong to acquirer, no doubt about that. Now, on the date of acquisition, we may say that acquirer is having this much of what we call share in the net assets. Now, on the date of acquisition, we are having this much of net assets, but we have paid some amount to acquire control over this much of assets. So I'm going to now compare the acquirer share of net assets with the amount of consideration transferred. Now, if the amount of consideration transferred will be more than the share, then the difference will be goodwill. Otherwise, it will be gain on bargain purchase. This is how you are going to compute the amount of goodwill or gain on bargain purchase. For example, with the help of this example, suppose I am interested in finding out the amount of goodwill. How I am going to find out the amount of goodwill? As we saw, the net assets on the date of acquisition, net assets, I'm simply writing net assets. Net assets of acquiring entity on the date of acquisition is equal to 10 lakh. Isn't it or not? Here we have written net assets of A2 on the date of acquisition is 10 lakh. So on the date of acquisition, net assets of acquiring entity happens to be 10 lakh. Now, out of that, first of all, I will have to find out the share of NCI. And in order to find out the NCI share, I have the choice whether I want to compute NCI on PSNA basis or on fair value basis. Now, suppose I adopt PSNA basis. Now, if I adopt PSNA basis, then we can see that the share of NCI will be equal to 3 lakh because proportion of NCI is 30%. So 30% of 10 lakh will be equal to 3 lakh. So out of 10 lakh, 3 lakh worth of net assets on the date of acquisition belong to NCI. And as I told you, the balance will belong to acquirer entity. So I will write here acquirer share, acquirer's share. Acquirer's share. So acquirer's share of net assets, acquirer's share of net assets will be equal to 7 lakh. Acquirer's share of net assets on the date of acquisition in the net assets of acquiring company is 7 lakh. Now I am going to compare it with the amount of consideration transferred. We have already seen that we have paid a consideration of 9 lakh, I think so, right? 9 lakh we have paid to acquire the control of 70%. So amount paid by us is 9 lakh. On the date of acquisition, we got the control through payment of 9 lakh, but we got hold of only 7 lakh. That means the amount of consideration exceeds the share of net assets. So that is why it is a loss to us, and that is why it will be considered as goodwill. Is it clear to you or not? So in case your amount of consideration is more than the share of net assets, then it will be a goodwill. And in the other case, if the amount of consideration happens to be lesser than the share, obviously in that case, there will be capital reserve or gain on bargain purchase, as we call it. Is it clear to you or not? Is it clear? So this is how, as far as accounting standards are unfold. Now coming over to all these particular points, now the next point is, I have already told you that on the date of acquisition, we have to prepare the consolidated balance sheet. And how the consolidated balance sheet will be prepared, that I will let you know in a short while. In order to prepare the consolidated balance sheet, let's come directly to this particular question so that I can make you understand better. Come over to this particular question. Section 1. First of all, if you have the books, kindly open down your section 1. Those among you who have already subscribed to our books, kindly open first of all section 1, Ind As 103. I'm talking about illustrative case studies. This is your first section. In this particular section, I have given you a question. Balance sheet of A and B Limited as on 31st of 3/2026 is given to you. Now, in this particular balance sheet, you must have noticed, first of all, I have written here towards the asset side, A and B. Non-current asset, property, plant and equipment of A Limited is equal to 20 lakh and of B Limited it is equal to 15 lakh. Now, coming over to current asset, kindly actually rectify this. Actually, this figure is 15 lakh. Current asset of A Limited is 15 lakh and current asset of B Limited is equal to 10 lakh. Total is equal to 35 lakh and 25 lakh. Besides that, we are now towards the liability side. We are being given that share capital of A Limited is 10 lakh and share capital of B Limited is 5 lakh. And one share is of rupees 10 each. Don't forget that. Correct? So total number of shares of A Limited will be 1 lakh into 10. That is 10 lakh, and total number of shares of B is 50,000. So 50,000 into 10 will be equal to 5 lakh. Other equity. Actually, other equity means reserve and surplus. Correct? In the terminology of Ind As, we do not use the word reserve and surplus. Instead, we are going to use the word other equity, and other equity means reserve and surplus, that is profit and loss, general reserve, etc. So other equity of A Limited is equal to 5 lakh and other equity of B Limited happens to be 10 lakh. Besides that, we are being given what we call your liability also, 20 lakh and 10 lakh. Correct? Now we move over to the next part. In the next part, it is given, actually this balance sheet is given to you on 31st of 3/2026. And very next day on 1/4/2026, It is given that A Limited acquired 60% stakes in B Limited against a consideration of 12 lakh to be discharged in cash. So this time we are acquiring 60% stakes in B Limited and we are making a payment of 12 lakh to discharge the consideration. Although I have solved the question, but still I would love you to actually do it in this manner, correct? I will require a bit of space, but how will I create the space? The question is this. Okay. Now, in order to understand this particular question, first of all, you need to understand 2-3 things, very important whenever you start the question. I've already told you your first step is determination of acquirer, although you need not require to do this much of mental stretching. Determination of acquirer. How to determination of acquirer, accounting acquirer. We know that A Limited is acquiring 60% stakes in B Limited. So quite obviously, from the legal perspective, A Limited is the legal acquirer and B Limited is the legal acquirer without an iota of doubt. But we have to find out acquirer for the accounting purpose. So accounting acquirer. This is our first step. In order to determine the accounting acquirer, I have already told you, first of all, you write here group. The group comprises of A and B. And I want to know the number of shares of the group. Now, number of shares of the group. I told you earlier, when we say number of shares in the group, it means indirectly, I will take into account the share capital of A. I've already told you share capital of legal acquirer is taken into account for this particular purpose. Whenever we want to know the total number of share or total share capital of the group, we will take into account the total share capital of legal acquirer. So total number of shares of A we have already seen in the balance sheet, that is equal to 10 lakh. This is total share capital and one share is of 10 each. So number of share is 1 lakh. And remember, you are discharging the consideration by way of cash. So that is why your share capital will remain 1 lakh. Now out of this 1 lakh, we can say that held by A, 1 lakh shares. All the shares are held by A Limited and B Limited is not having any shares out of these 1 lakh. So in the group, total share capital is 1 lakh and entire share capital is in the hands of A Limited. So A Limited will be your accounting acquirer. Is it clear to you or not? But I have already told you 99.99% the legal acquirer will also be the accounting acquirer. Anyway, this is your first step. So after having done up with the first step, your next step will be step number 2. Under step number 2, you always try to find out the net assets. The net assets of acquiring company. Net assets of acquiring company. Net assets of acquiring company. Acquiring company is B. And in order to find out the net assets, you can use any of these approach. You can find out net assets by simply subtracting liabilities from the assets. We know that net asset is always equal to asset minus liability. For example, in this particular case, if I am going to ask you a very simple question, tell me the total assets of B Limited, 15 lakh plus 10 lakh, that is equal to 25 lakh. So total asset is equal to 25 lakh. And liability, here it is given 10 lakh, as you can see. So I'm going to subtract the liability. I will get 15 lakh as net assets. So net assets of acquiring company is equal to 15 lakh. Net assets of acquiring company is equal to 15 lakh. I can also find out net assets in this manner. And henceforth, we will never use this approach of determining what we call net assets. Although this approach seems a little bit simple, simply because of the fact that we are more acclimatized to this particular method since our what we call journey into commerce stream. We know that net asset is equal to assets minus liability, so it appears a little bit simple, no doubt about it. But still, I do not want you to use this way of computing the net assets. We know that net asset is also equal to net asset, obviously asset minus liability, but net asset is always equal to equity. Net asset is always equal to equity, and equity means share capital plus reserve and surplus. Share capital plus reserve and surplus. And in Ind As, instead of calling reserve and surplus, we will call other equity. So we can see that net asset is always equal to equity, and equity always means share capital plus other equity. So I can also determine the amount of net assets through this approach. See here, I can simply take into account the share capital of subsidiary company, and we have seen that share capital of subsidiary company happens to be 5 lakh and other equity is 10 lakh. So it is also very simple. So 5 lakh is share capital and other equity is equal to 10 lakh. So I will simply add share capital and other equity. I can still get the same answer. So we may say that 15 lakh is the net assets of acquiring entity on the date of acquisition. Is it clear to you or not? On the date of acquisition, now we have determined the amount of net assets. Now, after this, what you do after this, your next step should be to determine the amount of NCI, non-controlling interest holder. Now, here it is not written whether NCI is to be computed on PSNA basis or on fair value basis. So you can compute it on PSNA basis, correct? So I will write here PSNA basis, proportionate share of net assets basis. So I can compute the amount of NCI by applying PSNA approach, that is proportionate share of net assets. We have already seen that net assets on the date of acquisition is equal to 15 lakh. So I will write here 15 lakh. And then I'm going to multiply it with the proportion of the NCI. What is the proportion of the NCI? Because you have acquired 60% stake. So 40% proportion actually belong to NCI. So that means out of 15 lakh, 6 lakh worth of net asset belong to NCI. Is it clear to you? Belong to NCI. After this, we have to find out the amount of goodwill. Now, in order to determine the amount of goodwill or gain on bargain purchase, goodwill or gain on bargain purchase, goodwill or gain on bargain purchase, I told you what we are supposed to do. You simply take into account the net assets. When I say net assets, it means net assets of acquiring company on the date of acquisition. And net assets on the date of acquisition we are computed earlier is equal to 15 lakh. So net assets of acquiring company on the date of acquisition is equal to 15 lakh. Out of this 15 lakh, you subtract less NCI's share, as I told you earlier. Now we have just computed NCI's share. We just computed NCI share is 6 lakh. That means out of 15 lakh, 6 lakh worth of net asset belong to NCI. So remaining is equal to 9 lakh. This remaining means share of acquirer. This is share of net assets of acquirer. So acquirer share of net assets on the date of acquisition is actually 9 lakh. Then I told you, you are going to actually compare it with the amount of consideration transferred. Now consideration, in this case, it is clearly given that you are paying rupees 12 lakh. So consideration amount is 12 lakh and the amount of consideration is pretty high in comparison to your share of net assets. So that is why the difference will be considered as goodwill. So 3 lakh will be considered as goodwill. Is it clear to you or not? So 3 lakh will be considered as goodwill. Is it clear? So this is how you are going to compute the amount of goodwill. You have already computed the amount of NCI. And the last thing is that you are supposed to pass the entries. Now you are in a position to pass the entry. If you want to, actually, honestly speaking, in order to prepare the consolidated balance sheet, we need not require entries, but still you should be aware of how you need to pass the entries. In order to pass the entries, I have already told you all the assets and liabilities which are appearing in the balance sheet will be taken over of the acquiring company at fair value. But in the question, fair value is not given clearly. So we presume that whatever value is written in the balance sheet is the fair value itself. Correct? So we will take over all the assets. That there are two assets, will take over the liability also. So all the assets and liability. So our entry will be like this: property, plant and equipment. Property, plant and equipment account debit. Now, in the balance sheet of B Limited, that is acquiring entity, property, plant and equipment is 15 lakhs. So I will take them over. Similarly, current assets are also there. I am going to write current asset account debit. Now, current asset is equal to 10 lakh. I am going to write here 10 lakh. Isn't it? Besides that, I am going to write two liabilities. I have taken over their liability which is appearing in the balance sheet at 10 lakh. Honestly speaking, on the debit side, we have written, because we have debited assets, total asset 25 lakh. Now we have written two liability. That means indirectly so far I have written only the net assets. So net asset is 15 lakh, 25 lakh minus 10 lakh. Then I am going to write here to NCI. When I am writing here to NCI, indirectly what I am trying to do here is I'm trying to find out of total net assets of 15 lakh, 6 lakh belong to NCI and rest of the asset belong to us, that is 12 lakh. Now I am going to write here to consideration. That means now I am comparing the share of net asset of acquirer with the amount of consideration. Actually, we write here consideration payable. Now consideration payable is 12 lakh. Actually, you can derive the value of the goodwill through entries also. Now, in this case, the balancing figure which you are going to derive over here, this will be considered as goodwill. Is it clear to you or not? So, amount of goodwill will be 3 lakh. So, this is how you are going to pass the entry. Is it clear? And then, you will have to pass another entry. Another entry will be for payment of consideration. Now, you will write here consideration payable account. Consideration payable account. Now, consideration payable is 12 lakh. So, you will write here 12 lakh. To cash account, you have made a payment of, you have made the payment by way of cash. So, you are going to write here 12 lakh. So, this is what you are supposed to do. And after this, you are supposed to prepare the balance sheet. And in order to prepare the balance sheet, what you are supposed to do here, see here. Now, our 5 steps are over. Now, 6th step is your balance sheet. 6 steps are over. Now, your balance sheet preparation. This is known as consolidated balance sheet. In order to prepare the consolidated balance sheet, first of all, you need to understand that all such companies which follow Ind As, they will have to prepare their balance sheet as per division 2, as per division 2. And when I say as per division 2, it means we have to write assets first and equity and liabilities later on. Is it clear to you? Under division 2, assets are written first. So first of all, you are going to write here non-current asset, then property, plant and equipment. You are the acquirer entity. You will write your property, plant and equipment 20 lakh. Now you have just written this entry. You have taken over 15 lakh worth of property, plant and equipment of your acquiring entity. So you are going to add it. And this is known as consolidated amount. So in the balance sheet, the consolidated amount of property, plant and equipment will be equal to 35 lakh. Similarly, you are going to write your own current asset. And you have taken over the current assets of your acquiring entity, that is 10 lakh. Correct? So you are going to add this 10 lakh over here. But at the same time, you should not forget that you have paid 12 lakh to discharge the consideration. So that is why I will subtract 12 lakh also. So total current asset in the balance sheet will be equal to 13 lakh. And important point is that in the workings, correct, or in the accounting steps, we have computed the amount of goodwill also 3 lakh. So this 3 lakh, you should not forget to write while preparing the consolidated balance sheet. You are going to write 3 lakh goodwill also. So your total of the asset side is equal to 51 lakh. Another important point, when you are going to prepare the equity and liability side, it is of paramount importance. While preparing consolidated balance sheet, share capital and other equity of acquiring entity, that is, okay, I will write it this way, acquiring entity, of acquiring entity will never ever be written. While preparing the consolidated balance sheet, you will not take into account the share capital of the acquiring entity. You will not take into account the what we call other equity. Is it clear to you or not? For example, in this particular case, when I am going to write here equity and liability, first of all, I am going to write equity, then I am going to write equity share capital. And in the equity share capital, I will take into account only the share capital of acquirer entity. I will not take over the share capital of the acquiring entity. Why? Because the reason is that the share capital of the acquiring entity has already been used for the computation of the net assets, and other equity also of the acquiring entity has been used for the computation of the net asset. That means share capital and other equity of the acquiring entity is already exhausted, so you cannot take them again. Similarly, when you are going to write the other equity, you will simply write other equity of acquirer entity. Then as far as your liability is concerned, 20 lakh is your liability and you have taken over the liability of your entity 10 lakh. So you are going to write 10 lakh. So you have already added it here. So total amount will be 30 lakh. Similarly, in your working step, you have also computed the amount of NCI. So NCI is always written under other equity, but it is always written as a separate line item. So you are going to write it over here. So total will be equal to 15 lakh. That means when you are going to prepare your consolidated balance sheet, it is of paramount importance that you should not forget this particular point, that share capital and other equity of the acquiring entity will never ever be written. The reason being is that they get already exhausted when we compute the net assets. Is it clear to you or not? So this is the point which you need to consider. Now another point is, we take another question before we finish off this particular session. It is already pretty long, I know, and I'm also pretty tired. Now, in this particular question, the balance sheet of A Limited and B Limited as at 31st of 3/2026 is given to you. You can see in here it is written A Limited, B Limited. Correct? This question is quite similar to the one which we did earlier. Same amount. You can see here even property, plant and equipment, that is 20 lakh, 15 lakh, current asset 15 lakh, 10 lakh, total 35 lakh, 25 lakh. Same figure. Everything is almost same. Correct? Share capital 10 lakh, 5 lakh, then other equity 5 lakh, 10 lakh, and liability 20 lakh and 10 lakh. Everything is same so far. But here in this particular question, actually you are being given on 1/4/2026. A Limited acquired 60% stakes in B Limited. This is similar to the last one. And we paid a consideration of 12 lakh and we are making a payment by way of cash. Correct? And this time the change is here. This time you are being given fair value of property, plant and equipment, current asset and liabilities. Question has stated only fair value. So you must understand that this is fair value of items of B Limited, whether question states or not. That means whenever fair value information will be given in the question, unless and until specifically stated, you will always presume that fair value information is related to items of acquiring entity. Is it clear to you? Now you must have noticed, actually the property, plant and equipment in the balance sheet is given at 15 lakh. But now here what is happening is that the fair value of property, plant and equipment is now 17 lakh. That means it is going up by 2 lakh. So it is a gain to you. Correct? It is a gain. Similarly, current asset, if we'll see current asset, that is 10 lakh, but its fair value is 2 lakh. And similarly, the liability is 10 lakh in the balance sheet, but its fair value is just 7 lakh. So again, it is a gain because the value of the liability is coming down. So again, it is a gain. In fact, all these three items, the changes in fair value of these items is resulting in a gain. And further in this question, it is also given there is a contingent liability having a fair value of 1 lakh in the books of B Limited. So that means your acquiring entity is also having a contingent liability. I've already told you that you will have to take over this liability also. No doubt about that. And kindly, actually, this line may not be written in your notes, so kindly write it. NCI will have to be measured at fair value. So this time it is given that we have to measure the NCI at fair value also. So in this question, it is given that we have to measure the NCI also. So in order to measure the NCI, what I am going to do is just pay attention here, first of all. In this question, correct? As usual, the first thing is that I'm supposed to compute the accounting acquirer, but the accounting acquirer will be A Limited only. Is it clear to you? If we are going to find out, you'll find out in a similar manner as we did in the last question. So your accounting acquirer will be A. Step number 1. Accounting acquirer will be A Limited. Accounting acquirer. Accounting acquirer. A Limited will be your accounting acquirer, correct? You will use the same methodology as I used in the last question, correct? So, and honestly speaking, whenever the purchase consideration will be discharged in cash, under such a situation, always the legal acquirer itself will be the accounting acquirer. Anyway, point number 2, date of acquisition. Date of acquisition is actually 1/4/2026. 1/4/2026 is your date of acquisition. Point number 3, technically and logically, as I told even in earlier question, in the last question, in the preceding one, that we are supposed to compute the net assets on the date of acquisition of the acquiring company. But in this particular question, because some fair value information is given, so first of all, I am going to actually compute the fair value changes. Fair value changes. Fair value changes. Fair value changes. Now, in order to compute the fair value changes, we have already seen that property, plant and equipment, there is a gain. Because the value of the property, plant and equipment is going up from 15 lakh to 17 lakh, so there is a gain of 2 lakh. Is it clear to you? Similarly, current asset. In the balance sheet, it is given as 10 lakh and its fair value is 12 lakh. So again, there is a gain of 2 lakh. So I'm going to write here 2 lakh. Besides that, there was another information with respect to liability. The fair value of the liability was determined at 7 lakh. So again, it is a gain because the value of liability is coming down. So it is a gain, correct? So it is a gain. So I'm going to write here 3 lakhs. So total gain, if I'm going to compute, the total gain is equal to 4 plus 3, 7 lakh. But we must not forget that we are taking over a contingent liability also. And if I'm going to take over a contingent liability, I told you, because in the balance sheet value of the contingent liability is 0, because contingent liability acquiring entity hasn't written in the balance sheet. That is why it is a contingent liability, because it is written in the footnote. So it is not appearing in the balance sheet. Obviously, it is a contingent liability. But you will have to take this liability and you will have to record it as a liability. So this is a loss to you, and you will have to record the contingent liability at fair value. So that is the reason I will write here contingent liability, because ultimately I will have to take the contingent liability, and taking over of contingent liability is a loss, 1 lakh. So net gain on account of fair value and contingent liability is equal to 6 lakh, we may say so. So whenever in the question, if such sort of information is given with respect to fair value, first of all, you compute what we call revaluation gain or fair value gain. Is it clear to you? After that, you are going to compute the net assets. Then your next step will become computation of net assets. Now, in order to compute the net assets, net assets of acquiring company, net assets of B Limited. B Limited is the name of acquiring entity. Now, in order to compute the net asset, I told you, and I have already told you, that we are not going to adopt assets minus liability approach. We will take equity approach. As per equity approach, I will take into account the share capital. We know that share capital of B Limited is equal to 5 lakh, isn't it or not? Share capital of B Limited is equal to 5 lakh. It is given in the question itself. Then we will take into account the other equity. The other equity of B Limited is equal to 10 lakh. I just told you net asset is always equal to equity, and equity is always equal to share capital plus other equity. Actually, other equity comprises of all types of reserves. Now, what happened in this particular case, on the date of acquisition, as we saw, there is a revaluation gain or fair value gain of 6 lakh. So it is a sort of reserve also. We call it fair value reserve. So this fair value reserve is also considered as part of other equity. So that is why in order to compute the net assets, you will take that into account. So fair value gain or fair value reserve, whatever you may like to write. Correct? So share capital plus all types of reserves is nothing but your equity, and equity always equals to net assets. So fair value reserve is equal to 6 lakh. So I can say with surety that on the date of acquisition, 5 plus 10, 15 plus 6, 21 lakh. So total net assets of acquiring entity is equal to 21 lakh. Now we can say that total net asset is equal to 21 lakh. Once we have determined the total net assets, the next step is to determine the amount of NCI. Now in this question, it is clearly mentioned that NCI need to be computed on fair value basis. So NCI on fair value basis. NCI on fair value basis. We have to compute the value of NCI on fair value basis. Now on fair value basis, what will be the value of NCI? In order to determine the value of the NCI on fair value basis, I told you, whenever you are supposed to compute the NCI on fair value basis, first you think coolly actually, what is the interest of acquirer? Acquirer has got 60% interest or 60% stakes. And for 60%, we have made a payment of 12 lakh. So this is considered as fair value of 60% stakes. So what will be the fair value of 40% stakes? So 40% stake, what will be the value? That is 40 into 12 lakh, 40 into 12 lakh divided by 60%. Divided by 60. That is equal to, I think, 8 lakhs. So now we have determined NCI on fair value basis 8 lakh. Indirectly it means whatever net assets of acquiring company are there on the date of the acquisition, out of that 8 lakh worth of net asset belong to NCI. Now we are in a position to find out the amount of goodwill. In order to determine the amount of goodwill or gain on bargain purchase, goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. What you are supposed to do in order to determine the amount of goodwill or gain on bargain purchase, first of all, you will have to write the net assets of acquiring company on the date of acquisition. I am simply writing net assets because of lack of space, but it means net assets of acquiring company on the date of acquisition, which we have already computed. That happens to be 21 lakh. So I'm going to write here 21 lakh. So 21 lakh is the net assets. And now I'm going to subtract NCI share. Out of 21 lakh, we have just computed NCI on fair value basis 8 lakh. So that means the remaining asset 21 minus 8, 13 lakh. 13 lakh worth of net assets belong to acquirer. Acquirer share. So acquirer share is equal to this much. Acquirer's share. So acquirer share is equal to 13 lakh. Now you compare it with the consideration transferred. Amount of consideration. What is the amount of consideration? 12 lakh. Now in this case, the amount of consideration is lesser than the what we call share of net assets. So this time there is a gain, and this gain will be considered as gain on bargain purchase. This will be considered as gain on bargain purchase. Is it clear to you or not? Is it clear to you? Then, if you want to pass the entry, you can pass the entries also. Your entry will be, the first entry will be property, plant and equipment. You are going to take over the property, plant and equipment because the fair value is given. So fair value of property, plant and equipment on the date of acquisition is 17 lakh of acquiring company. You are going to record it at fair value. Similarly, fair value of current asset was given to us as 12 lakh. So I'm going to record the current asset at 12 lakh. Correct? Then I'm going to write here two liabilities. The liability which is appearing in the balance sheet is 10 lakh, but its fair value is 7 lakh. So I'm going to record the liability at 7 lakh. Is it clear to you? Besides that, I must not forget that I will have to take into account the contingent liability. So I will have to take into account the contingent liability. That means I will have to recognize the contingent liability. Contingent liability is 1 lakh. Clear? So all the assets and liabilities are taken over. Then I am going to write here to NCI. NCI share is equal to 8 lakh. So I'm going to write here 8 lakh. Then I'm going to write here consideration. Amount of consideration is 12 lakh. Now in this particular case, this is 29 lakh and this is 8 and 8, 16 and 12, 28 lakh. So this time the balancing figure is not coming over here. If balancing figure is not coming over here, that means there is no goodwill. Balancing figure is coming over here. So gain on bargain purchase. So gain on bargain purchase or goodwill can be found out by passing this particular entry. Is it clear to you? You can directly pass through this particular entry, and you must not forget to pass the second entry of discharging the consideration. Your consideration amount is equal to 12 lakh. And you must discharge the consideration, that is equal to 2 cash. 12 lakh. So this is how you are supposed to do. Now you will have to prepare the consolidated balance sheet. And in order to prepare the consolidated balance sheet, what you are supposed to do, I have already told you. You will have to look into the entries and you will have to look into the column of the acquirer. That's all. For example, if I am going to prepare the consolidated balance sheet in this case, I will look into the acquirer. Property, plant and equipment. Now acquirer's property, plant and equipment is 20 lakh. Now I will look into the entry. I have taken over property, plant and equipment at 17 lakh. So I'm going to add it here 17 lakh. So total will be 37 lakh. It is as simple as that. Similarly, our means acquirer's current asset is 15 lakh. And we have taken over the current asset at 12 lakh. So at whatever value we are going to take over, we are going to add here. But because we are making a payment of 12 lakh also for consideration, I will subtract cash. So ultimately my current asset will be 15 lakh. In this case, there is no goodwill. So total will be equal to 52 lakh. Now coming over to the equity and liability side, I told you in the balance sheet when I am going to write the equity share capital, I will write the equity share capital of acquirer. Similarly, other equity of acquirer will be written. But here very important, there is gain on bargain purchase. We have computed gain on bargain purchase. Gain on bargain purchase is also considered as a part of other equity. You simply write it this way, other equity, then gain on bargain purchase. Is it clear to you? Besides that, we have computed the NCI. So I will write the NCI also 8 lakh. Is it clear to you? Now, we have taken over the liability at 7 lakh. So I'm going to write 7 lakhs. Actually, you have written here 7 lakh. I mean to say 10 lakh is printed here. There is not a single printing mistake in this entire book. Only printing mistake is in these two questions. So kindly write here 20 lakh plus 7 lakh, 27 lakh. This is your liability. But you must not also forget here, because it is always better to write it is always better to write the entries, because everything which you have written in the balance sheet in your entry must get exhausted. For example, contingent liability. So far we haven't adjusted it. So contingent liability will also figure in the balance sheet. Contingent liability. Contingent liability you must not forget to write in the balance sheet, that is equal to 1 lakh. Contingent liability, and this figure will be equal to 27 lakh. Liability will be equal to 30 lakh plus 7 lakh, 20 lakh plus 7 lakh, 27 lakh. Contingent liability 1 lakh, and your total will be equal to 52 lakh. Equity share capital 10 lakh. Then other equity 5 lakh, gain on bargain purchase 1 lakh, NCI 8 lakh. Then you write what we call liability 20 lakh plus 7 lakh, 27 lakh. Then contingent liability, that is equal to 1 lakh. This is how you are supposed to prepare the balance sheet. So it's a pretty long session today, and obviously I hope and personally hope that it must have had come up to your expectation. Looking forward to have your feedbacks as always, correct? So that gives us immense pleasure. And of course, if there will be some other suggestion, we definitely never shy of putting them into practicality. So on such count, we take leave of you. Shall meet you in the next session with something new, correct? So till then, time to say goodbye.